Let's break down one of the most popular tools in technical analysis, the simple moving average. A simple moving average, or SMA, helps smooth out price action and makes it easier to see the overall trend. It works by taking the closing prices over a set period, adding them up, and dividing them by the number of days. For example, a 200-day SMA adds up the last 200 closing prices and divides by 200 to create one smooth line on the chart. Besides confirming trends, traders also use moving averages to spot possible reversals. When a shorter moving average, like the 20 SMA, crosses above a longer one, like the 50 SMA, it's called a golden cross, which might signal an uptrend. On the other hand, when the 20 SMA crosses below the 50, that's a death cross, and it could mean a downtrend is on the way. Moving averages can also act as dynamic support and resistance levels. If the price is above the line, it can act as support. If it's below, it might act as resistance. Simple, powerful, and super versatile. That's the simple moving average.